Hello, this is Dave Shepson. I'm an accountant and adjunct professor. Been teaching for a while, and this is part of a series of videos that I've created based on certain accounting topics to help students review or help students learn them for the first time. In this particular series of videos, we're talking about closing the accounting cycle, and in the last video we went over working through the worksheet and using the worksheet as part of the closing process, and now we're going to get to the closing entries. So if you need to review the worksheet, you might want to go back and find part 1 and do that first. But without further ado, let's look at how we close out the cycle. So the first thing we need to do is review some things about types of accounts. There are permanent accounts and temporary accounts, and there's only 3 types of temporary accounts. Let's step back a minute and look at where we are in the cycle. Everything starts, of course, with source documents, and based on those documents we make journal entries, and those are then posted to the general ledger, or you might have seen them visualized as T accounts. And based on the balances at the end of the month in all of those accounts, we make a trial balance. And of course, all of our debits and credits should balance at that point. Then we make adjusting journal entries to account for revenue and expenses that wouldn't have been triggered by our source documents, things such as depreciation and earning unearned revenue, things of that nature. And that will then yield an adjusted trial balance after we make those adjustments. And we will work through the worksheet to create our financial statements. Now, what we need to do at this point, and what this video is about, is how to do the closing journal entries that actually make the accounts and the balances in the accounts match what we've created on our statements. And then we'll wrap up with a post-closing trial balance. So we have to close our temporary accounts, and in order to do that, we need a trash can, because we've got to dump them somewhere. These are the only types of temporary accounts that there really are. There are revenue accounts, expense accounts, and draw accounts, and these all, as we learned earlier, are going to affect equity, and they get closed out at the end of the period. So let's take an example. I'm just going to consolidate all of our expense accounts into one and all of our revenue accounts into one, and say we have sales and expenses. Sales, of course, being the revenue account, and expense being an expense account. And there's our trash can. We're going to dump everything in. And our trash can has a special name. We create a special account. You can call this an extremely temporary account because it doesn't carry a balance at all through the month. We're only going to dump things into it and then dump things out of it very quickly. And it is called income summary. And that is our trash can. So let's say at the end of the month, through the accumulation of activity, we have an ending balance of $5,000 in our sales account on the credit side, and a debit balance of $2,000 in expenses. If I'm going to close one, I just need to put the same amount on the opposite side. So don't overthink this. If I want to close sales, I know the first thing I need to do is debit sales, and that brings that account to 0. And all we're going to do is post the offsetting entry into income summary. Again, you don't have to really think about why. We are using income summary as a pass-through or a garbage can. So whatever you have to do to close out one account, you post to the opposite side of income summary. So you have a debit and credit with that entry. And we're going to do the same thing with expenses. And what we've just accomplished is we have no balance now in our sales and expense accounts. But of course, if you look on any financial statements, you're not going to see income summary on the financial statements at all. It's an extremely temporary account. It's just a garbage can. So we need to get rid of it. So here's journal entries of what we just did. We closed sales to income summary, and we closed expenses to income summary. And that brings us back to our balance. Now I've put up here our capital account because we've been telling you all along that these temporary accounts all affect equity. They all affect our capital account. So now is the next step is pretty easy. We need to get what our balance is in income summary. So our balance right now is $3,000 on the credit side. Well, if I'm going to close that, I need my garbage can. So by putting $3,000 in the garbage can, I'm putting it on the left side to zero out income summary, and that's putting it in the garbage can, which means I have to post the offsetting entry to the right side of capital. I'm dumping it right out. And this is exactly how my garbage can income summary works. You just dump everything into it and you immediately dump it out. And then I can see the effect of that on capital. We now have $23,000 of capital. And if you think about this scenario, it makes sense. If you go back to what we looked at earlier, we had $5,000 of sales and $2,000 of expenses, which means our sales were more than our expenses, which means we had net income. And if we had a net income and not a net loss, it should have the effect of increasing our capital at the end of the month when we close. So this is doing exactly what we would expect it to do. Of course, if we had more income than expenses, we would be having a debit balance in the income summary account, and to close it, we would make a right-sided or credit entry, and then our offsetting entry would be a debit entry to capital, which would have the effect of reducing the capital. But I'm just showing you a net income here as an example. So then, the next thing we have to do is close income summary. We have to get rid of the garbage can, and that's just the journal entry of what we just did. We dumped everything into income summary. That brought it to a balance of $3,000. Now we closed it and posted it to capital. That's the journal entry for what we just showed in the T accounts. The last thing we have to deal with is draws. Draws are a funny account because they are what's called a Contra account. They're a Contra equity account. When we draw money out, we don't just take it directly out of capital. We take it in draws. The reason we do that, even though it's going to have an effect on capital when we're done, is that we want to see on the financial statements the effect of money being taken out by the owners. And the statement that this shows up on, of course, is the statement of owner's equity or statement of change in owner's equity. It's going to show the effect of the contributions of the owners, draws of the owners, and, of course, net income, anything of that nature. So we just want to see it separately on the financial statements, and that's why we create this sub-account or Contra account that has the opposite normal balance. So this is pretty typical of what you would see. We've got a debit-sided balance of draws. That's the opposite side of what an equity account normally has, and that's what is typical for a Contra account. So it's not a revenue account, it's not an expense account, it is a Contra equity account that is a temporary account. It only carries a balance during the month, and then we close it out. And I bet you can guess what we're going to do. We're going to close it out by posting a right-sided or credit entry, and that leaves us a zero balance, which means we have to put an entry on the left side to capital. And that then reduces our capital balance to a $22,000 on the credit side. So our net income increased it $3,000, but our draws decreased it $1,000. And here is what the journal entry would look like to close draws. And this is always going to be the journal entry because draws will never have a credit balance. Income summary can end up with a credit or debit balance depending on whether income or expenses were higher. But draws only ever get a debit entry to them, so they accumulate on the debit side. So to close them, it's always going to be this. The only thing that's going to change is the date and the dollar amount. Now let's go back to our process here and see how this worked. We have now closed the journal entries, and we're going to do a post-closing trial balance. Of course, a post-closing trial balance is exactly the same as any other trial balance. It's just the one that you do after you've done the closing entries. Two reasons we want to do this. One, we need to make sure our debits and credits still balance, because if they don't, there's a mistake somewhere. And that's one of the purposes of any time we do a trial balance, to identify errors. The second thing I would really pay attention to is when you are done, all of your temporary accounts, any revenue type of account, contra revenue account, any expense account, and draws should not be on there. There should be no balance on any of those accounts if you have closed properly. So those would have a zero balance. And if you see those two things being true, then you're probably good. And then we start the process all over again.